Good afternoon. This is Ken Long from Tortoise Capital with a review of the daily trading plan for May 23rd, 2011. Market is in bullish normal conditions, give us a slightly upward bias. Annual basis 64 out of 100. On weekly RSI 14 is just above average, but still neutral. 10-day look back using 10-day NDX is at 37 out of 100, or just slightly above oversold conditions. 200-day moving average at 8% stretch above the 200 is bullish but coated white, so it's been a lot stronger in the last 180 days. The slope of the 50-day moving average at 0.15 is bearish. Although it's slightly positive, it's been so much stronger before that it's relatively weak. ADX at 11 is a sideways choppy market. ATR percentage at 1.15% is increasing and high on the normal side compared to the last 100 days. Looking at the 30-day gap stat in SPY, 14 times in the last 30 days the market has gapped down. 9 out of those 14 times it has continued to fail for an average follow-through of minus 0.29%. 5 times after it's gapped down it has reversed to close higher with twice as much follow-through, averaging 0.53%. It is gapped up 16 times out of 30. 8 of those times it has reversed to close lower for an average of minus 0.47 follow-through. 8 of those times the gap up has continued to gain for follow-through of 0.42%. The percentage play then is to wait for a positive follow-through that has slightly outperformed the reversal and fails. The range stat for SPY is 1.47, so little change over last week. So 1.5% move is the maximum average normal move in SPY. That's about $1.80 in symbol SPY from low to high. 10-day index, looking at a time series, you can see we have come out of oversold conditions, tested overbought, and are now nearer to oversold than otherwise. That's a sideways choppy market in action. No signals on overreaction or channeling. You can see the pivot points in SPY. There's not very much distance at all from the pivot at 133.88 to R3 at 135.72. So that's really only a range stat move away. This is a very tight sideways looking market. You can see the increase in volatility slowly creeping back into the market over the last 30 days. We're now slightly above average, halfway to volatile market conditions. ADX has dropped below 11, and you can see that plus DI and minus DI are very close to each other. Sideways choppy market, no directionality indicated. On 10-day max pain, we're looking at some technology and basic industrials with Hewlett-Packard, Cisco, Caterpillar, Alcoa, and Bank of America and Max Payne for the Dow. In the ETF 100, the VIX, silver, metals and mining, Germany, and Japan among the ETFs. The 10-day min pain, or the outperformers, the usual suspects: Kraft, McDonald's, Procter & Gamble, Coca-Cola, and Verizon. Inside the pattern trades, we've got a washout pattern in natural gas. We have 5 days down in Hewlett-Packard, and that has an almost 10-to-1 reward-to-risk ratio when considering a retest of the previous swing high. If that one goes, it'll go large. 551W in Disney, triple screen in Johnson & Johnson. That's a good opportunity to buy strength on a measured pullback. That's one that should be framed and monitored carefully. Channeling in financial sector, JP Morgan, Travelers, and Alcoa. That suggests that if the financials have some strength, that JP Morgan ought to be on our short list for stalking. So if we see the market up and financials up stronger, consider JP Morgan. If it's the leading candidate in that sector, then pile on JP Morgan. In the elder safe zone, we have measured improvement in the commodity areas with gold, blended commodities, energy, coal, and oil. Silver wheaten got measurably stronger on Friday. Only Japan was measurably weaker using the elder safe zone technique. 3060 stealth for things that were horrible 2 months ago that are slowly getting better. U.S. technology, agriculture, Japan, and treasuries. In the large caps, it's Procter & Gamble, Intel, Microsoft, and ExxonMobil. Procter & Gamble is on here as a 10-day min pain and a stealthy improver. I like that, especially given the strength in healthcare. Looking at a summary of the Dow 30 tactical summary, a handful of dojis. We have channeling signals, and these are the channeling signals for J.P. Morgan, Travelers, and Alcoa. You can see the 5-day down in triple screens as earlier observed. Hewlett Packard is number one for max pain range compression, followed by Caterpillar, Cisco, Alcoa, and Bank of America. All of those test out pretty well. You can see just how horrible Hewlett Packard has been in the look-back periods ranging from 3 days all the way back to 12 months. It's coded red, meaning it's been exceptionally weak compared to all its peers in the Dow. Of interest, though, is that on Friday, that's the only time that it wasn't measurably horrible. And so that corresponds with that max pain range compression. Perhaps the short-term pain is over, and that's the way that trade frame works. Pfizer, I like the fact that it's had a 1-day and a 3-day underperformance. That could be the opportunity to buy into a healthcare leader on an overreaction. So that deserves attention. Procter & Gamble is of interest on the other side of it. A strong sector, but it had great performance on Friday. So if we see strength in healthcare, one of those two will be the leader, and that'll be the way to play it. J.P. Morgan, 3-day sell-off, and again, we have to see strength in financials to be interested there. Kraft, you'll notice that's the only thing that's coded green on the Tortoise Index over every measurable look-back period. Because those scores are above 100, that means it closed at a new high for every one of those look-back periods. So its close Friday was a new 12-month high, a 6-month high, 3-month high, and so on all the way through. So that's measurable strength for you right there. By the same token, Hewlett Packard's close was at a 12, 6, 3, and 1 month low, and that's kind of a washout on exactly the other area, on the other end of the spectrum. Bank of America made a dramatically new low for the 3-day look back at minus 38 on the 10-day index. So that could be an overreaction play for us there. Same ideas inside the ETF 30. The percent winners on Friday: VIX, natural gas. Though outperformance 1 day by natural gas UNG is what created the washout pattern, so we'd be looking for second-day momentum potentially there. Percent winners in blended commodities, oil and gold. The internationals in Europe were the big fails on Friday, with EFA and IEV being percent losers. Additional charts for the market mosaic. In the northwest corner, a 30-day regression line in blue. The R-squared at 0.26 says it is a reasonable description for the 30 days of price action. Looking at the time series, you can see it's actually below the 6-month average, and so this would be indicative of a gradually weakening, aging bear that has not been able to make new highs. The series of of lower highs over the past 6 months just says the steam is coming out of the bear. You can see that also reflected in the southeast here with the percent stretch above the 200-day moving average. It has pulled all the way back to the 6-month average after having stretched almost 2 standard deviations above just 3 months ago. So this suggests, however, that it's found support at this level before, and if it makes a 1 standard deviation move here, that represents a potential for a 5% reversal and an upward move. It would still be in a channel, but it could move 5% north and still be consistent with this sideways action. That would get it back up just above 137, which is the recent swing high. You can see ADX has tailed off I'm sorry, that's a zoom in on the 30-day regression line slope, and pure sideways market, no directionality suggested there. Just for your reference, the intraday range stats highlight silver at 6.75% looking at the last 30 days, so that's on a $35 ETF. That's a $2 move intraday between low and high in silver is within the range of normal. So those range stats are available for reference for the top dozen ETFs and the Dow 30. 30-day quality report, I'm looking for things that were red on a 2-month look back and yellow or white on a 1-month look back. That gets us towards Microsoft, Intel. You can see the outperformance in Procter & Gamble. One of the reasons I like this report is that things that were exceptionally horrible 2 months ago that are slowly getting better can experience a system quality number of change like Procter & Gamble, which went from minus 1.62 system quality number to 5.10, and that's sort of the magnitude of improvement that's available when things come off a hard bottom like that. Inside the ETFs, we'd be looking at Japan, Treasuries, S&P Technology has gone from red to white, so that's a potential stealth improvement. That's corresponded with a improvement in the Qs as well, which had gone from the weakest U.S. sector last week to about midpoint in the U.S. sectors this week. Safe zone channel just showing basically a sideways market in SPY over the last 20 days, little to no change, and you can see the gap statistics not just for SPY but for all of the big indexes and selected commodities. Pivot point calculations for reference. And that's everything that I want to highlight from the daily trading plan. Again, we have a number of short-term candidates, lots of patterns that can be framed for day one techniques and swing trades. With the sideways market and little follow-through day over day, it makes sense to frame shorter-term trades and take the bird in the hand rather than the two in the bush. This is Ken Long from Tortoise Capital. Keep your powder dry and risk measured.